Hello and welcome to another financial analysis video. Today I'm talking about Caterpillar, and Caterpillar earlier this week gave earnings and they gave us some bad news. We were expecting bad news, but they gave us even a little bit worse. 75 cents a share versus 78, and as you could just tell by this chart, things with Caterpillar have gotten progressively worse over the last few quarters. The mining industry obviously has taken a spill. The dollar is strengthening against global currencies, and so it's making it harder for Caterpillar to sell exports. And as we could see from the data, revenue continues to drop. Cash flow and free cash flow are also on a downhill trend now. Interestingly enough, 4.2 billion is the trailing free cash flow mark. Now, looking at the dividend yield, which is now at 4.33%, and looking at the dividends, we see that there is plenty there in terms of cash to pay dividends out, and I think Caterpillar is going to maintain that. But it is important to note that in the latest earnings report, the payout ratio hit the 100% mark. So Caterpillar actually reported less in earnings than they will be paying out in dividends here in the next few weeks. So investors should keep a look out for continuing earnings that are below the dividends, and also keep an eye on this free cash flow. But for the time being, I think it's sufficient. It's interesting because I wonder, with the stock going up in reaction to the earnings, and I'm just kind of looking around at things and seeing, the PE ratios, and now the earnings yield has dropped because we're taking this group into trailing PE, and it is replacing this right here. So your earnings yield is going to plummet. Whether or not this is the time to buy Caterpillar, I tell you, if you have really a very, very long-term outlook, you may be advantageous to start dipping into this right now. However, my standpoint looking at this is a $60 to $70 stock for a pretty extended period of time. I have Caterpillar on my list in the event of a recession to see it come down, and it would be on my list of things to get into coming out of that recession. I think they would do very well there. They're sort of I think, in my opinion, a blue chip performer once you hit the bottom of a business cycle. So it depends on what your investment preference is here. But obviously the quarterly results were weak, but still within the realm of holding the dividend, eye that payout ratio, eye the free cash flow, and go from there. I hope you enjoyed this video. Happy investing.